Went through a fairly unstable period in the mid-1990s and actually through the latter part of the 1990s where trade was a big issue. I think the way markets are trading right now is very consistent with the whole China story. You look at the FX market and everything that you'd expect to be stronger between the yen and the Swissy is stronger. EM commodity currencies, the Chinese currency are weaker. Credit, equity markets are trading accordingly. The bond market's been very responsive, so I think everything's very consistent so far.
And your best trade ideas in that context? What trend continues?
Look, I think it's there's going to be very little gain without additional pain, unfortunately. I think pain in terms of the economic data, pain in terms of the financial markets is what's going to drive this bargain, really. It's going to drive the two parties to the table. So things are going to get worse before they get better. I think it's just, strong opinion on that side. So it's more of the same as far as, a lot of what's going on in the FX side. I think the dollar's going to hold its own, probably weaken a little bit against the yen, but be stronger against pretty much everything. It's going to be very, very interesting to see whether dollar China starts to break higher. What the Chinese do there will be very instrumental in terms of how destabilizing these markets will become. If they hold it below 7, all is a little bit more comfortable, shall we say, than if we start breaking through 7.
So, Jim, can you buy the dips in this stock market on days like today with the market so vulnerable to every tweet from the president?
I don't recommend people try to trade the news here. I think we may have some more pain before we have some gain. I don't think we're going to have a lot more pain, though, because of where the level of interest rates have gone. Now, if you look at 1990, if you want to look at these past historical references, look at 1990, 1995, 2000, you had a real Fed funds rate that was somewhere between 3.8 and 4.7. Now the real Fed funds rate is about 0.59%. We have negative interest rates in much of Europe. We have ultra-low interest rates around the world. So from a strategic standpoint, U.S. stocks still look pretty good. But your question, Sarah, was about the tactical. Do I do it right now? I think we are going to see a little more volatility. Remember, we had a V-bottom in December. We had a big rally to where the Wall Street had missed everything. We were up higher at the high at about 15% on the S&P 500 that anybody had predicted for the year. So it's natural now. We're in this May through October time frame, which is historically a little more volatile. Now we have this news. It's a good reason for equities to start to adjust and start to consolidate and correct. But if you look at the trade wars, and let's assume we're going to go all out and put tariffs on everything, you're looking at about 1% on GDP maybe. On earnings, you're looking maybe at about a 5% correction there. That implies about a 10% correction in the market. We're already somewhere around 5%, depending on which day you look at it. So I don't think there's a tremendous amount of downside here, Sarah, but I do think it's time maybe just to maybe de-risk a little bit and not be too aggressive on the buy side. Be a little patient in the summer time frame.
All right, Jim, I'm not saying everybody at UBS has to agree on everything, but Trahan did just go to 25.50 for year-end. Clearly, you're more bullish than that.
Well, we have an investment bank. He's on the investment bank, and then we have the chief strategist and on the other side, and he's at 29.50. So you can pick and choose there. Now, in terms of where I think we are, maybe I'm a little more bullish because of the real level of these Fed funds rate. If you look at the historical precedents that Trahan represents, we had a much higher Fed funds rate. So I go back to the strategic there. Where are you going to put your money? With a 10-year Treasury yield now sitting at this year's lows, you don't really have a lot of attractive asset classes to choose from in here. So we could correct some more, but I think at the end of the year, we're going to be higher than where we are now.